Welcome back to the deep dive. Today, we are putting away the headlines and grabbing the financials. We're going to get really granular on the commercial real estate market.
Yeah, specifically what the actionable opportunities look like in Texas as we launch into 2026.
It feels like an essential exercise. I mean, investors are repositioning post-holidays, and this momentum from the end of last year is, well, it's critical to understanding what's out there.
Exactly.
Our source material today is really targeted. It's the EBG Listings of the Week email newsletter from Eureka Business Group dated January 3rd, 2026.
And this isn't just a random list. EBG curated this as their top opportunities.
Yeah.
The ones they see as the best value coming into the new year.
So our mission is to basically pull apart this exclusive stack and extract the key investment insights.
And for anyone who doesn't know, EBG, that's Eureka Business Group, they're a major player, especially in the Dallas-Fort Worth, the DFW market. They've been around since 2008, a full-service brokerage. They really specialize in guiding retail investors, franchisees, business owners through the complexities of retail CRE.
So investment sales, landlord rep, property management, they do it all.
Think of them as the expert navigator for retail in that constantly changing market.
So what's the pulse of the market right now? Their internal notes said they're carrying forward momentum from, and this is a quote, the busiest December the industry have seen in years.
Wow.
That's not just a brag, right? That suggests huge transaction volume, a lot of investor confidence, and probably some serious competition for quality assets.
It confirms that liquidity is high and sophisticated buyers are definitely out there looking for value. So the assets we're about to talk about are, hitting a hot market where speed really matters.
Okay, so let's unpack this list. We'll start at the entry points, the listings priced under $2 million. These often represent, unique value-add plays or smaller deployments for individual investors.
Yeah, and this bracket is fascinating because it forces sellers to get creative with financing, with pricing, which can mean built-in benefits for a smart investor.
Let's start with a classic value play in McKinney, Texas, high-growth suburb. We're looking at a 2,900 square foot medical office space.
Right, and the flexibility here is key. It's two combined units, so an investor could lease it all to one big tenant or split it up for smaller practices.
Flexibility is great, but what really jumped out at me was the price. The source says it's selling well below the county assessed value.
And that's the real nugget. In a market this hot, finding a property with immediate, built-in equity like that is incredibly rare.
So explain that for our listener. Buying below assessed value sounds good, but what does it actually do for your bottom line right away?
Well, it dramatically impacts your financing and your risk. When you go to get a loan, the bank's going to do its own appraisal, of course, but buying below assessment, that's strong evidence of immediate value creation.
Okay.
It usually means you can get a lower loan-to-value ratio, an LTV, right from day one, that could boost your leverage for the next deal or just give you a cushion for a quick refinance.
And on top of that, EBG has this exclusively, and they're offering owner financing. That's like a triple win. Easy transaction, better terms, and you sidestep some lending headaches.
Exactly.
Okay, next we move a bit south to Louisville, Texas, and we're pivoting from that value-add risk to stabilized income.
Yeah, this is a 3,127 square foot single-tenant retail property. And it's occupied by a pet care tenant called the Pet Squad.
Which is a perfect example of defensive, necessity-based retail.
Right.
Absolutely.
Right. Pet care, vet services. That's non-discretionary spending. People don't stop taking care of their pets just because the economy gets a little shaky.
And the lease structure backs that up. There are 7 years remaining on the lease with solid 3% annual rent escalations.
Yep. The location's in an affluent, high-growth submarket, so the tenant has access to a growing customer base. This asset is all about long-term, predictable income with guaranteed growth. It's a portfolio stabilizer.
But I have to ask, while that predictability is great, doesn't a 3% annual bump kind of limit your upside? What if the market just explodes and rents jump 5 or 6% a year?
That's the core trade-off. It's a fair question.
Are you giving up too much potential?
You are, but this isn't designed to be a high appreciation asset. It's more like a bond. You're trading that potential market growth for absolute certainty of cash flow and, frankly, minimal management headaches.
Ah, so the investor buying this wants exactly that. They don't want to worry about market resets.
Precisely.
Got it. Okay, now let's go to the complete opposite end of that spectrum. Pure development potential. We're looking at 2.2 acres of mixed-use land in Mesquite.
This is the high leverage play, the long-term capital appreciation play. It's not generating a single cent of cash flow today.
But the potential is huge.
Massive potential returns if the development gets bid.
And that potential is, well, it's significant. Mixed-use zoning, 320 feet of frontage on a main road, Gus Thomason, and the possibility for up to 84 apartments plus retail.
Look, when you invest in raw land, the biggest hurdle is almost always entitlement risk. Getting the city to actually approve your project.
Right.
The critical detail here is that the city supports redevelopment efforts along this corridor, that municipal backing is gold. It signals the city is actively incentivizing development, which de-risks that whole future approval process.
So we've just seen the whole sub $2 M bracket psychology right there. You've got the immediate value add in McKinney, the income stability in Louisville, and this pure development future in Mesquite.
It really does set a dynamic stage. It shows that buyers are looking for value wherever they can find it, whether it's through a discount or through a partnership with the city.
Let's move up the scale. The sweet spot for a lot of established investors.
Yeah.
The $2 million to $5 million tier. This bracket seems to be all about less active management, which brings us right to the triple net lease, the NN.
Right. NNN leases are, they are foundational to passive commercial investment. They shift all the major property expenses, taxes, insurance, maintenance onto the tenant.
Okay, let's start with what a lot of people call the gold standard of passive real estate, an absolute NNN lease. It's featured in this listing for a 2,274 square foot QSR, a quick service restaurant in Houston.
Yeah, and an absolute NNN is even better. With a standard NNN, the landlord might still be on the hook for, say, the roof and structure.
Okay.
With an absolute NNN, the tenant handles literally everything, including those big-ticket items. The landlord truly just collects what people call mailbox money.
And this asset has a long-term tenant, been there since 2009, and it sits on a corner that sees 52,000 vehicles per day, 52K VPD.
That 52,000 VPD number, that's the justification for the premium price. High traffic means high visibility, great customer access. It's why a strong QSR franchise is willing to sign that kind of long-term secure lease.
And a strong franchise guarantor is backing the lease, which minimizes the landlord's risk. But I have to ask, if this is such a perfect gold standard asset, why is EBG listing it? Why didn't some big fund just scoop it up before it even hit a newsletter?
That is an excellent question. It gets to the heart of how CRE deals work. Often these assets come to market because of a specific seller need. Maybe they're doing a 1031 exchange and need to redeploy capital quickly.
Or they're retiring or something.
Or retiring, consolidating a portfolio. They're high-quality assets being sold out of strategy or necessity, not because the asset itself is failing. EBG's strength is bringing these very specific opportunities to their list of investors.
That makes sense. Sticking with NNN reliability, let's go back to Mesquite, a 16,400 square foot retail center.
This is a 100% leased multi-tenant center. And a big positive, they just finished extensive renovations in 2025.
So no immediate CapEx needs.
Exactly. No deferred maintenance surprises.
Yeah.
And of course, all the leases are NNN.
The key location detail here, it's directly across the street from a Walmart.
And Walmart is the ultimate retail anchor. It guarantees just massive, consistent consumer traffic to that area. So while Walmart isn't a tenant in the center, that co-tenancy effect is huge. It ensures all the smaller shops benefit from that endless stream of customers.
Which means low vacancy and strong renewals.
You got it.
Okay, moving on slightly, let's focus on a couple of really desirable asset types right now, medical and new construction. First, a 6,573 square foot medical office in Cedar Park.
Well, when investors want stability, they look for non-discretionary services. Healthcare is at the top of that list. This is a Class A multi-tenant medical office, also 100% leased, NNN.
And the security here comes from strong medical guarantors on the leases, right?
Right, and those built-in annual rent escalations that keep you ahead of inflation. The location's a signalized hard corner, which means max visibility and easy access for patients.
Which is critical for medical practices.
Precisely. And medical tenants tend to be stickier. They sign longer leases, they're less likely to move because of the high cost of moving all that specialized equipment and patient records.
Okay, and for our last one in this tier, we're looking at new construction. Capitalizing on explosive demographic trends. A 16,000 square foot retail center in Melissa, Texas.
Melissa is one of those legendary high-growth DFW submarkets.
Yeah.
I remember when Melissa was just open fields 5-6 years ago. The rate of change is just staggering.
And this center was built just last year, 2023. And it has a brand new 10-year lease.
So you're buying a physically modern asset, built to today's standards, with minimal immediate capital needs.
And you're basically aligning that full 10-year lease with the peak growth curve of that area's population.
It's a clean investment. It's based entirely on securing long-term returns from future population growth.
All right, now we shift to the highest tier on EBG's list, moving into that $5 million to $10 million bracket. This usually requires assets with some real regional drawing power.
Exactly. This tier demands significant anchor tenants, ones that drive massive foot traffic and ensure stability for the whole center.
Which takes us to Little Elm, Texas, a 13,079 square foot retail center.
The anchor is everything here. This center is grocery anchored by India Bazaar. Grocery anchors are considered defensive retail because, people go there multiple times a week, no matter what the economy is doing. And an anchor like India Bazaar serves a specific cultural niche, which gives the center a unique competitive advantage in a really diverse, affluent submarket.
And it's 100% leased, all NNN, with a new 10-year anchor lease in place. That long-term lease is the cornerstone of its valuation.
Right. That grocery anchor minimizes risk, not just for the landlord, but for every smaller tenant there. It makes the debt service more secure, which at the end of the day means a higher appraised value for you.
Okay, before we wrap it all up, EBG included a really unique opportunity, the CHISD assets. 4 separate assets available through a sealed bid process. This is completely different from the fixed pricing on everything else.
Yeah, sealed bid process is often used for institutional or, non-standard assets, like firm or school district property. The seller wants to find out the market's absolute best price without a long negotiation.
So what kind of investor is best for that kind of competitive bidding?
It definitely requires an investor who's comfortable with a lot of upfront due diligence and, frankly, a lot of uncertainty. You have no idea what other people are bidding.
So you have to be really confident in your own numbers.
Highly confident in your valuation model, yeah. It tends to attract institutional buyers, specialized development funds, people who can execute a quick close once their bid is accepted. It's not for the passive or the faint of heart.
So we've covered the whole risk and value curve here, from raw land in Mesquite to an absolute NNN restaurant. What are the key takeaways from EBG's best value list for January 2026?
Well, if we connect all the dots, I see 3 themes that define best value right now. First, there's a clear flight to passive stability. You see that in the overwhelming emphasis on NNN structures.
Especially the absolute NNN.
Especially those. Second, the investment focus is hyper-local. It's targeting specific, rapid-growth DFW submarkets, Louisville, Melissa McKinney, where that demographic boom fuels future tenant demand.
And the tenant profile is obviously critical.
Absolutely. The sustained strength of these necessity tenants, medical, pet care, it just shows that investors are prioritizing safety and non-discretionary spending. And finally, the creative deal structures, like owner financing or selling below assessed value, that tells you that while the market is hot, sellers are still willing to offer incentives to get clean deals done.
And if we call back to that initial observation about the busiest December, the diversity on this list, from raw land to grocery-anchored centers, it really confirms that investor confidence and momentum are just extremely robust across all these different CRE asset classes as we head into 2026.
The market isn't slowing down. It's just getting more creative. It's a highly competitive and dynamic landscape where that specific local knowledge, the kind EBG provides, is just critical.
And that leads us to our final provocative thought for you, the learner. Given that we saw explicit city support for redevelopment in a place like Mesquite, and we saw properties selling below their assessed value in McKinney, how might a savvy investor strategically balance those two things? How do you balance the stabilized income-producing assets like the NNN medical offices that provide steady cash flow now with those long-term, high-leverage capital appreciation plays, like the mixed-use land that requires heavy lifting but has that crucial municipal support? That fundamental balancing act, income today versus exponential growth tomorrow, that is the defining challenge of modern CRE investment.